Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow, it's interesting looking at all the headlines, how many of them are negative. That's actually, to the contrarian, that's a pretty good sign. When everybody else is, running for the door, it might be time to start looking around for opportunities. And I think we're seeing that right now. Valuations are still a little bit high, though. That's the only troubling part about this. And the what's interesting to me is I would have thought that at this time in my career, I've only been doing this for 32 years now. I would have thought that the old stuff that used to happen a lot would have stopped happening quite so frequently. But right now you've got the best performing categories are still, or at least over the last few weeks, are the tech stocks who have the highest valuations, which I think is really interesting. At some point in time, that is going to move around, and it's going to come to some stocks that basically have barely budged for several years, despite the fact that their revenues and their profits are up pretty significantly. So just have to kind of wait and see how that's going to happen. All the volatility just keeps reminding me, incidentally, that fixed income is a big part of most people's portfolios. It always has been for us. And I think it's still going to make a lot of sense. And we'll talk about that a little bit later in today's show. But the various types of fixed income, right now, I think you've got really good CD rates out there. If you buy CDs from your brokerage firm, most of the brokerage firms buy and sell CDs from banks. There's a big network out there. It still has FDIC coverage. What's interesting is you can get more than one CD from, you can go above the normal SIPC insured guarantees, and you can have a couple $1,000,000 and they would all have FDIC insurance as long as they weren't overweighted in one bank, which is kind of interesting. And I really like treasuries are even better as far as I'm concerned. You don't have to pay local income tax on treasuries, and the rates are extremely close. I mean, it's kind of funny. We'll be watching during the day. We'll be buying some in the morning and then buying in the afternoon, and the prices will have changed a little bit during that time period. Not a lot, but just a little. And treasuries really, actually, you have to check each day to see which one's going to be paying more, a CD or a treasury. And so they've been very close to brokered CDs, and I think that's pretty interesting. Getting back up around 4%, it's really going to take a lot of pressure off of an awful lot of people. That a CD is part of a program, part of your portfolio, the fixed income portion of it. And rates are not quite as high as the distribution yields on fixed index annuities, but they're getting closer. And actually, the fixed index annuities have started to creep up a little bit now in response to that, because when you have a fixed index annuity, or just a fixed annuity, even a fixed annuity, the insurance company's going out and investing the dollars that we invest with them into the same markets that all the mutual funds and all the pension funds, they're using the same markets. So when those rates go up, the rates on annuities can go up as well. And I think that's really important to keep in mind. They can go up. They typically don't respond nearly as quickly as Treasury bonds do, but eventually they respond. And if you're at a point where you think, look, I'm going to be retiring in another 4 or 5 years, I'm really this volatility has my stomach going up and down and churning every day. That might be a really good option to consider for a portion of your money. And I've worked with several people where they had a specific expenditure. Some of them wanted to pay the premiums on their Medicare supplement program that they had, and then that's all they wanted to do. You have to be aware that those premiums over time will go up. So if you're going to look to do that with an annuity, you either need to look to one that also goes up over time, or one that you're not going to put quite as much in, and you'll take some of the extra money that you don't have to invest in, because when you buy the ones who adjust for inflation, you have to put more money in it to be able to generate the starting income that you may need to get. So the others they take less money up front to pay that starting income, but you know the premiums are going to go up over time. So you'd better leave some money in a fund to handle the inflation in those premiums. And it gets complicated, doesn't it? And I try to make it as simple as I can. And I'm telling you, if you looked at how I lived, I should be on those. Do they even have magazines for the minimalists? I doubt it, because they're not buying much. But I still buy a lot of stuff, but I don't like to have a lot of stuff laying around my house. And it's pretty funny. Yeah, if you don't want to be forced to live that way, by the way. So this is why planning is kind of important. I mean, it's very important, although it doesn't need to get super complicated. Sometimes, it does. Occasionally, it's going to be complicated. It's just the way life is now. But in many cases, you just want to try to keep things as humanly possible, as simple as you can. And what I mean by that is, like, when you get ready, when you start looking at retirement planning, getting to that point. And by the way, when you should start retirement planning? When you're about 12. When you're about 12 years old. And the reason why is, I'm going to tell you, there's a rule called the 4% rule that a lot of financial planning people use. And essentially it says, whatever your account balances are for retirement, you don't want to take more than 4% out from the starting value. And then you're going to adjust that 4% for inflation. You're going to raise it each year. That's why it's only 4%. Now, as with every rule, it's going to have exceptions, and your situation is probably going to be a little bit different, but that's a good ballpark. So if I'm going to withdraw 4%, and then I'm going to increase that over time to keep up with inflation when the cost of food goes up and gas goes up and everything else goes up. So I'm going to start at 4, knowing that I'm going to have to raise that. All right. So if I had $1 million, 4% of $1 million is $40,000. Now that doesn't seem right to an awful lot of people, but it is. Get your calculator out and check it. So to generate $40,000, and you're only going to take out 4%, you need $1 million. And that's where people get shocked. And but I wouldn't worry about it. If you're in your 40s, 50s, 60s, you just got to do the best you can. And more often than not, when I'm sitting down with somebody, we'll take a look at their plan, and oftentimes they can do it. They've got enough money saved to be able to take out a 4 or 5% a year, let it supplement their Social Security, their retirement income. If they have some sort of a pension, that's great. My Social Security, by the way, I haven't checked it in about 2 years, and I know they've been raising because of inflation. And when I checked it, they don't adjust the future projections for inflation. And mine was like 2 years ago. It was over $4,000 a month for an individual. And I'm thinking, just for Social Security, that's pretty interesting. And it's the you can go to socialsecurity.gov, sign up, get an account, and get an estimate right there. They'll send it to you. Actually, it's not an estimate. This is what it's going to be. So if there's an error there, you don't have a whole lot of time to catch it. You need to look that up really quickly, and it's a big deal. I mean, if I'd have told my grandfather I'm going to get $50,000 a year from Social Security when he was my age, he probably would have slapped me for thinking him so dumb. But that's the impact that inflation has on just about everything. And I'm sure, I mean, that's a non-inflation adjusted number because, like I said, I haven't done it for 2 years. So it's probably significantly higher than that right now. And I think it's pretty interesting that can happen that way. So, yeah, keeping, by the way, I forget how many years you get. I'll have to go back and double check that. But if there's an error on that, on your record for Social Security, you don't get a ton of time to fix it. It's no 6 or 7 years or something. I think it's like 3 or 4 years. So if you see an error, and this is one of the reasons you should just go up and sign up. Just Google socialsecurity.gov. Actually, you can type that in and it'll probably take you right there. But sign up for that. That's a big deal. And it is a big deal for the vast majority of people. Oh, by the way, I forgot to tell you, I'm actually in the studio live today. So you can call us, 216-901-0945. Number is 216-901-0945. I hope everybody had a good Thanksgiving. I hope you guys are all fired up over the Ohio State-Michigan game. Actually, I really don't care if you're fired up for it, but it looks to be a really good game. And very interesting on that dynamic. They're both undefeated. That's pretty wild. So anyway, I was talking kind of about Social Security, getting keeping up with that. You know, when you get your annual reports from all your retirement plans, I mean, it's a big deal. I think the vast majority of people in this country don't think a lot about retirement until they get up into their 40s and sometimes in their 50s, and that's really rough. You have to accumulate an awful lot of money to be able to maintain your lifestyle, or any lifestyle really. It's just a really difficult thing to do, and the earlier you get started on it, the better off you're going to be. And from that standpoint, there are a lot of really good packages out there, or 401k plans. I see them all the time, and you really need to take advantage of those. Try to do the best you can, as much as you can. Understand that when you are putting money into the 401k plan, you're not paying federal income tax on it. That saves you a ton of money. So, and I can hear it in the back of my head every time I make that statement. Somebody goes, yeah, but you're going to pay taxes on it one day. Well, hopefully you'll be paying taxes on it plus what it has grown by, and hopefully that's going to be a lot. And I hope that you have to pay a lot of taxes, because if you're paying a lot of taxes, that means you're making a lot of money. And that's pretty interesting. So I see, are we taking calls today? Oh, all right. Sorry about that. Technical difficulties. I guess the equipment in the radio station today is not it's operating the way I feel, actually. But here we go. I'm going to go to the phones right now. And again, if you want to call, you can call 216-901-0945. Going to line one. Is this JR? Hello?
Yes. Good morning, Professor Bullington. Are you there?
I am here. How are you?
Good. I hope you had a wonderful Turkey Day with your family.
Thanks. You too.
Okay. My question is, with the impending recession that everybody feels we're going to have, interest rates are at a sky-high rate now. Well, we'll put it this way, they're higher than they've been in some time. Do you see, as the recession takes hold, interest rates will come down? Should they not, because of lack of demand?
Well, that would be the normal. Okay. That would be the way that it happens normally. I got about 30 seconds before I have to take a commercial break, but I'll just put you on hold because I really want to talk to you about this, if that's okay.
Yeah, I'd love to hear what your opinion is on that.
Yeah, because it's I've been thinking about that almost every day.
Okay. That makes two of us.
Yeah, and it's really fascinating. When they say it's different this time, I mean, it is really different this time. But anyway, if you want to hang on, this is Bill Bullington right here on 1420. Stay tuned. I'll be right back.
So good, so good, so good. I got a notion.
Redirect.com.
Okay, and we're back, and I have to apologize. Our phone system's not working well, so I have to ask who this is again.
This is JR. I'm waiting for my tutorial on interest rates.
Okay. Yeah, I'm sorry about that. We don't know who's calling on which lines. We just know the lines are lit up. But anyway, interest rates. They're supposed to raise interest rates to try to keep them like 1.5% to 2% above inflation. Okay. And or at least that was what they used to try to do. And oftentimes the Fed, they would wait for the numbers to come out and then make the adjustments. And this is like the first time I've seen them in my lifetime try to anticipate what's going to happen. Now, I don't watch them that closely, so I'm sure it could have happened 2 or 3 times before this. But for some reason, I was paying more attention this time. And you didn't have Google and the internet back in the other, under the other administrations.
Sure.
But I just don't know though. When they were raising interest rates back in the 70s, you had huge inflation. A large part of it was because there was this pretty popular government program called Medicare.
Yeah.
That was brought into existence in the late 1960s, and they started paying for it, and they were printing money to pay for it. And it caused double-digit inflation. Prices of houses went up 100% in 5 years during one of those time periods. I think that was 74 to 79, somewhere in that neighborhood. But anyway, you had massive inflation, and then Jimmy Carter comes in. He inherited it. The mess was there before he got there. Everybody blames him for that. Nobody bothers to go and read, to see what actually happened, because it's so much easier to blame somebody if you don't like them.
Well, Ford gave us a good bit of it, but Jimmy Carter didn't help things. I would say that.
Well, no, Jimmy Carter put an end to it. See, that's the accuracy part of it. He appointed a Fed president, and oh man, I can't believe how old I'm getting. Can't believe I forgot this guy's name.
That's not Volcker, is it?
Yeah, it was Paul Volcker, and Paul Volcker was very heavy-handed. And Jimmy Carter asked him. He said, "Hey, how do we fix this?" He goes, "If you want me to do what I need to do, you'll go down as one of the worst presidents that's ever lived." And Jimmy Carter said, "Well, will it fix it?" And he said, "Yes." And he goes, well, "Then go ahead and do it." And so he raised the reserve requirements and interest rates at the same time. So not only you're raising interest rates, now you're taking some of the supply of the money available to make loans. Okay, that was they're not doing that yet. That hasn't been done yet. They've just done the rates. So that was really heavy-handed, and it worked. I mean, it caused a recession. Okay. And of course, everybody did blame Jimmy Carter, just like Paul Volcker said they would. And inflation started coming down, started dropping like a rock. Okay, it did work, but I just don't know. I mean, the inflation that we have today. Back then, it was the oil prices were going up so much. You had unions across the country kept striking, and it was a wage price spiral and all that kind of stuff. But it was similar in some veins, but the thing that's really different about this is a lot of the shortage, I believe, in the oil and gas has come from the war that's going on in Ukraine. Well, there was no,
right.
I'm not sure raising interest rates is going to stop a war. See, that's
of course not.
That's the part that and it might. I mean, maybe it puts just so much pressure on them, and they force so much economic malaise on Europe and Russia that they go, you know what, we can't afford to do this anymore. Let's quit. Let's call it truce. Maybe it'll work, but I don't know. It's all I know is that interest rates are high. They could go a lot higher, but you never know whether they will or not. In fact, Peter Lynch was fond of saying, if you spend 15 minutes a year reading about economics, you've just wasted 15 minutes.
Yeah.
Because it will change. It's going to change relatively when it does it. It's amazing how quickly it can change.
But so it's not axiomatic if there's less demand that interest rates will come down accordingly?
Nope. Not at all.
I would have thought. I mean, now why would they? Now they'd want to stimulate the economy, at least get try to kickstart. They've already screwed it up bad enough. But
you would hope.
One would think if there's no demand, why would rates be at sky high? There's it's basic supply and demand.
Right, and that's my point. They haven't been using the language that you and I are using right now. I haven't heard anybody say anything about that. And so I'm scratching my head, going, "Wow, that is that's really different." So, but
yeah. So don't expect it. If it happens, great. If not, don't be surprised, I guess, is your observation.
Well, I remember home mortgages that were 22%. And see, my dad was a carpenter, and and we built a lot of houses that during that time period we were building in Strongsville, and he's just a carpenter. The guy that was the builder that took out all the loans ended up going bankrupt.
Ooh.
It was brutal. And I just remember the 22% interest rates on a mortgage if you wanted to get one, and you had to put more than 10% down. I think it might have been 20. But
people aren't going to be borrowing in that type of environment.
Oh
obviously.
Man, it just slammed the brakes on the entire economy. And but you know what? You didn't have Google back then, so not as many people knew about it.
Okay, very good. Thank you for your observations, William.
Oh well, thanks for calling. Have a good weekend.
Yeah, bye.
Yep, bye.
Bye.
This is Bill Bullington. You're on the Bullington Capital Report.
Hey, Bill, it's Jason. How you doing?
Hey, good. Thanks for hanging on so long. I feel bad.
Oh, no, I listen to your show. I try to listen whenever I'm out. I usually run errands on Saturday. I hear you normally. So I was happy to listen. And actually, I wanted to comment on the interest rate real quick before I ask you about Social Security.
Sure.
So, the 1.5 to 2%, the Taylor rule. I don't know if we should really say that the Fed's going to follow that, because the way they calculate the CPI now, I think, is a little bit rigged.
Oh yes, yeah.
You know what I mean?
Right.
So,
yep.
I think the other thing is, though, the Fed's kind of boxed in, because if you look at our debt levels of over $30 trillion,
right.
I think a lot of that is financed with short-term debt. If they raise the interest rate to 6% or higher, from what I've read, we won't even be able to make the payments on the interest. So they're really in a bad spot. But I wanted to ask you about Social Security, and when do you think, I'm 43, when do you think they're going to cut the payments on Social Security? I think they'll do a combination probably of raising taxes and cuts. And I'm just wondering, how much time do you think we got left before they start to cut it? Maybe, I don't know. I don't know what the percentage will be, but I'm assuming they're going to have to make cuts to what the payments are going to be. Not for people who are currently retired, but for people who, are at some point, they're going to say, here's the cutoff date. We're paying 20% less now, or whatever it is. What's your thoughts on it?
Actually, I think they're more likely just to freeze it, because if you freeze it and you have inflation and GDP does actually go up at some point in time, then you're collecting a portion of that excess GDP to help pay for Social Security. So if you were to freeze it and maybe extend it out to, I know if you froze it for even 5 years and extended the full retirement age to 72, which has been kind of bannered about, that would fix it.
And when you say, but when you say freeze it, do you think then that they'll get rid of the COLA that's within Social Security? So
yep.
that, oh man, because that COLA is not even keeping up with the inflation like it used to.
Yeah, no kidding, man. Because and this is something I had talked about a long time ago on a radio program. So you put the people in charge of raising Social Security also in charge of interest rates and spending. Who do you think gets taken advantage of there?
Oh.
And there's you also are putting them in charge of reporting as to what the real rate of inflation is, or what their rate of inflation is. The actual rate of inflation for somebody who's in their 60s, because of the rising cost of medical care being like 3 times faster or 2 times faster than the overall economy. They've been hurt the most, but they're also the least vocal. It's hard to yell when you're 80.
Yeah, no, good point.
But yeah, so I'm just so glad I am not a politician. I mean, that would be such a tough job. There's so much stuff that just needs to be fixed. And none of the fixes are easy. And anybody that does attempt to fix it's going to get voted out of office lickety split.
No, you're absolutely right. Yeah, that's the problem. The country, I mean, there's been a lot of mismanagement of the money over the years, special interests getting what they needed. But at this point, to take the medicine, I don't think any politician could survive to give the country the medicine they needed to fix this.
Neither do I. And by the way, you and I, the conversation that we just had is probably in the magnitude of 10 times more intelligent than most of the things that come out of Herschel Walker's mouth.
Yeah.
By the way, I was a freshman at Vanderbilt when he was a sophomore at Georgia, and we played them. The prior year, he had set the NCAA record for single game rushing against us. And I'd never heard him speak before, but I don't know. I don't know if he's a nice guy. I don't know anything about him. All I know is I think his thighs were somewhere around 32 inches back then. He was super fast and he could stop on a dime, and he was back to full speed in 2 steps. But that doesn't mean that he should be in government.
I'll tell you what, I agree, Bill. There's not a lot of people that I think in government that are doing a lot for the best interest of the people. At this point, I would just settle for somebody who's honest and who's not gonna take money from a foreign government or a lobbying organization when they get out of Congress, which I think is few and far between. Yeah,
I do too, and it's one of the reasons I really don't even follow politics anymore. I'll follow some of the laws when they come out, like the student loan forgiveness, which hasn't gotten actually completely approved yet, but I'll watch the laws. As far as who's drafting the laws and what the votes are, I just wait until it happens and then take a look at it and see if there's anything I need to do in the meantime.
How can they fix the education when they're going to subsidize the cost of these colleges by letting kids go to school for free? I mean, when I look back, I said in 1990s, late 90s, if you looked at what the cost was at a state university, right, I think average was like $4,000 or $5,000 a year, and a lot of state ones. You look now, it's over 20, and it's been because the people, either the taxpayer or the government, has been allowing this to get so bloated. If they go and let these kids go to school for free, they're going to major in gender studies and whatever woke BS they're giving them. They're never going to be productive. If you make them pay, they're going to have to pick a job based on the free market that is in demand. Yeah,
but see, you're talking about 18 and 19-year-olds.
Oh.
that I don't know. That's another one of the. I am so glad I'm not a politician. I don't have to make these decisions. They're not easy. I mean, these are really tough. And I thought, financial planning was hard.
Well, I won't keep you, Bill. Have a good rest of the weekend.
All right. Well, thanks. Have a good weekend. Thanks for calling, too.
Yeah, no problem. Thanks.
Bye-bye. If you'd like to call, numbers 216-901-0945, 216-901-0945. By the way, the Democrats and the Republicans get mad at me because I refuse to change my position, which is most of the time, I don't know. I don't know. Are interest rates going to go higher? I don't know. Are they going to go lower? I don't know. You don't need to know that. All you need to know is what you're going to do. That's what you need to know. And what are generally the better things to do? Normally, you want to stay out in bonds that are like 2 to 3 years, because if you're not, then there's going to be, at some point in time, rates are going to go up or down, and your stuff's going to renew. It's going to move along with that, but it will avoid you buying the 30-year Treasury bond. I feel bad for this caller. He called in a few years ago. He had purchased the long-term Treasury ETF, symbol TLT, and he was really happy about it because it had gone up. And I'm like, wow, that's a rally. That's something that we used to jokingly call a dead cat bounce. Dead cats don't bounce too much when you throw them against the concrete. I've never done that, by the way. I would never do that. And there are people around me now that are going, uh-oh, I just crossed the line. But anyway, the bounce that he got, is followed up by a decline that's over 30%. And if you look from the peak of where that long-term Treasury bond fund peaked, it's down about 40. And those are long-term government bonds. You got to be really careful. And no, I'm the only person I know of that's talking about this and bringing this to your attention. When you have a balanced account, okay, stocks, bonds, and cash, the bonds in that balanced account, I can promise you, are not the best bonds. Not today. They're good for, I'm sure that the firms out there, the big firms, that big money management firms, are trying to keep things shorter term maturities. But you know what? When you've got trillions of dollars to invest, literally trillions, you don't have a choice. You don't have a choice. You have to invest in some things that you would really wish that you wouldn't have to invest in. But the money has to go somewhere. You're not allowed to leave it in a non-interest bearing checking account. And so it ends up finding its way into categories that they shouldn't be there. And so, that's how bubbles get formed. And there's been a big bubble in bonds. And see, bonds don't bounce back like stocks do. Or typically don't bounce back like stocks do. So it could be an incredibly long time, and we were, it's painful when you're holding on to short-term bonds and those longer-term bonds, their rates are going up because prices are going down and people are attracted to it for all the wrong reasons. And they're going, hey, but it's paying this much. Yeah, but see, it pays that much, but the principal, the amount of money that you invested in it is going to go down. We'll talk a little bit more about that when we come back. This is Bill Bullington here on 1420. Stay tuned. We'll be right back.
Wake up and breathe in deeper than yesterday. Take on the morning like your soul's been remade. 95.5, the fish has got you.
Welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Feel free to go to my website if you have questions. It's bullingtoncapital.com. You can fill out the contact us form, and there's a slot there for a question. You can type it in there, and I will try to get back to you as quickly as I can. If you'd like to call in today, the number is 216-901-0945. I have to warn you that our equipment's not working like it's supposed to be, so I'm going to have to ask for your name, like I'm going to have to ask for this person's name. Oh, I guess they decided to. Oh, now it's coming back. That's funny. It's Bill Bullington. Bill Bullington. You're on the Bullington Capital Report. Guess not. Wow, we were having unbelievable technical difficulties today, so got to bear with us. Must be because that Ohio State-Michigan game's getting ready to be played. It's tearing up everybody's, whatever, overcrowding. Anyway, I was reading about the student loan forgiveness, and it's interesting. It's not what I thought it was initially, and there's a really good article on it in Wealth Management magazine. I believe you can get a copy of it by going to wealthmanagement.com. So if you've had taken out student loans over the last few years, and you might be eligible to have some of that relieved or forgiven, which I've heard a lot of people say a lot of stuff about that, and some people are really upset. Some people are really mad. Now, I had two choices when I got out of high school. I could go into the military, or I could take the football scholarship I was offered, and I think I should have gone into the military. As I'm sitting here, my body is aching. My legs are going, my left foot's going numb, my lower back is hurting, and crazy. Had I known, I probably would have gone in the military. But those were the options. So you could go to the military, do 4 or 5 years. I had good enough grades, though. I take that back. I had the Air Force Academy and the West Point. I had both the recruiters there coming in, and they both said, "Oh, I didn't take enough math," because I took my high school math in 8th grade, my first year of high school math in 8th grade. So I only had 3 years instead of 4 years of math in high school, because I didn't have to. And they looked at that and said, "Well, we're going to have to take another year. You'll have to go to this prep school." At 18, I was like, "What? Go to a prep? Have to wait another whole year? Forget that." So anyway, yeah, probably should have anyway. Don't know if I would have. I don't know what would have happened. But the bottom line is, they're talking about forgiving student loans. I didn't know anything about student loans. We didn't know about financial aid, that you could get help from the government. We lived out in the boonies. The teachers that we had, and I forget what they call them. We had people that would come into the school and try to help you out with that kind of stuff. But our school was so big, there were so many kids there that I never even spoke to anybody there. And I think they thought I was taken care of anyway. So bottom line is, there are a lot more programs today. There's a lot more money for kids. When they can't afford school, if they can pass the classes, kind of like Europe, a lot of European countries, if you're smart enough, they'll put you on scholarship. You can pass the classes and get good grades. They'll pay for your school. And I think that's what we should do here. And when I look at the amount of student loan debt that's out there, and I look at the amount that they're forgiving, it's not that much. I mean, you're talking, if you make a decent amount of money, anything over $125,000 a year, from what I'm looking at in this article, if this article is accurate, or if I'm interpreting it correctly, you're not going to get all that much. You're going to be eligible for $10,000. Is that a lot? I mean, I think Kent State's around $30,000 a year now, and so they're talking, making a big deal out of there. If you're not making a certain amount of money, then you might be eligible for up to $20,000. So I don't know. I look at how difficult it was. And by the way, you want to get beat up by a bunch of old guys? Go into a group of people above the age of 55 who played college football on a scholarship and tell them they had a free ride. You ain't getting out of there. I have never had to work that hard again. It was brutal. I'm sitting here, my body's in pain from all the injuries that I sustained. And, just never. I've never had to work that hard again. And I feel bad for these guys. Back in those days, only 1 in 5 ever even graduated. That because they had to spend so much time on this sport. And it was year round. You got off 2 weeks at Christmas and 6 weeks during the summer. And thank goodness for that, because I took the shortened summer school session. That's where I took all my hard classes. The only time I made the dean's list, too, by the way. And so I'm taking 16 weeks worth of credit hours in 6, and I'm making the dean's list. That's how hard football was. I wasn't even close to the dean's list during the regular school year. And that stuff just ain't right. It wasn't right then. I don't know. I hope it's improved. I think it's improved now, but it was brutal. Talk about I don't know, human trafficking in football players, in college athletes. I remember this coach thought he was really funny. We'd walk around, we're stretching before practice. You had to run, stretch, then run again before you started practicing. It took about 30 minutes, by the way. These stretches, you got a 270-pound lineman laying on your back, pushing your rib cage down to touch your knee. That's what the stretching is like. You better be, if you're not flexible when you come in as a freshman, by the time you're a senior, you can do the splits, no sweat. But so that even the stretching of it was not all that pleasant, should I say. And this coach used to come around and he would say, "Hey, at least you're not in Saigon." That's the kind of stuff that would go. And he actually designed a drill that he called Escape from Saigon. And it was brutal. I won't bother telling you about it. It's probably turn your stomach. But the bottom line is, I am so glad that those days are over. And I really paid. I'm still paying for that college scholarship. It doesn't really matter. I mean, anybody that's never gone through it doesn't realize, so I'm not looking for sympathy. I'm lucky to have been there. Lucky to have gotten a diploma and gotten to study some stuff that I really liked. That was nice. My major was economics, but which you'd think would be a lot of help. And back in those days, PCs were kind of new, and actually they were really new. So the amount of data that they have and the education that people have today, the fact that Google's out there, you can find almost anything. You got to be careful because you don't know if you can trust the source. But that was kind of the same back then. It was just they had to go through there were many fewer articles published on those types of topics because we just didn't have the distribution. At any rate, the economies still work very similarly to the way they always have. Supply and demand is a big deal. Everybody tries to guess at what the supply and demand is. I see people putting together these mathematical models. I think Warren Buffett once called these guys PhDs. Witch doctors with PhDs in computers, because a lot of the stuff that they try to do, everybody wants to know what the answer is. Everybody wants to know what the answer, where interest rate's going to be, what's the stock market going to do, what's Twitter going to do, how about Tesla, what's that going to do, and they all want you to be right, and they don't realize that when you are investing, especially when you're starting to think about retirement, you don't want to be gambling. I mean, because that's what you're doing when you don't have a lot of knowledge. And by the way, there's most people are not professional gamblers. When you're a professional gambler, you look, and a lot of professional gamblers have done very big. That's done very well. That's why they call them professional. And then you have all the others. And so you've got people that are working out there that know what they're doing. They put the probabilities in your favor in the long run. And what kinds of things are we looking at there? I don't really have that much time today, I don't think. Nope. We'll have to cover that next week. But the types of things that you want to see in your stock portfolios, because you're still going to need stocks if you plan on living for more than 10 or 15 years. If you are older than that, well, CD rates have started to come up a little bit. These fixed index annuities and regular annuities, the rates on them have come up quite a bit. Which one's the right one for you? I wouldn't know that, because it's like saying what kind of car is the best car for an individual. It depends on what they like. I mean, most cars will do. They'll get you to where you need to go. But if you're going to be driving it every day for the next 5 years, that's going to make a difference. And it's very similar to investing. How much money do you need? How long do you need it for? In other words, what do you think your life expectancy is? That's a dangerous one. By the way, I always try to plan on having the money last longer than I do. In other words, when I pass away, I want there to be something left there. A, because I don't know when I'm going to pass away. And B, because I'd like to leave something to my kids. And shouldn't be a problem. But, sometimes it is. And you got to think of yourself too. You still can't get nearly as much income from CDs or tax-free bonds as you can a lot of annuities. And that's why I've been bringing it up over the last couple of years, because it wasn't that, for a while there, it wasn't that case. That case did not exist. The rates on annuities the rates on all fixed income, it was so low. It was not a good thing to talk about, except for giving you balance to your portfolio, which, if you're in the right types, they did. They balanced it out. And, if you're in the wrong types of fixed income funds, those hurt you bad. So I guess my point to all of this is before you make a life-affecting decision, maybe you want to call somebody. Maybe you just want to talk. Just, here's my situation. It's really not as complicated as most of these magazines, like the one I was reading today, Wealth Management. They love to bring in all kinds of, regression analysis, and that's even so old they hate using that term. I guess since I hear the music, that means I'm going to have to follow this conversation up next week. This has been Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.